There's a new rule change in 2026 that affects every 401k plan in America, and this rule will determine whether you can contribute Roth dollars or traditional dollars. There's going to be some new situations where you don't get to choose and you will be forced to contribute Roth dollars. Now, this rule affects everyone, whether you have a 401k in corporate America, you're a self-employed person with a solo 401k, maybe you have a 403b or 457 plan. This rule is about catch-up contributions for any of you who are 50 or older. Now, under current rules, you can contribute $23,500 of Roth or traditional contributions to your 401k. For anyone 50 or older, you get to put in an additional $7,500. And in 2025, you can decide, do I want those dollars to be traditional dollars or do I want those to be Roth dollars? Now that rule changes in 2026, and this is the big change. There's a couple other things that are important, but the big change is starting in 2026, for certain Americans, you will no longer be able to make a catch-up contribution of traditional dollars. You will be forced and required to make a Roth-only contribution. I want to make sure everyone understands the difference here between Roth and traditional dollars. When you put traditional contributions into your 401k, you get a deduction. So for example, if I put in $23,500 into my 401k in 2025, that's the maximum employee contribution you can put in. And let's say I'm 50 years old, so I dropped in another $7,500, and I'm like, I want a tax deduction this year. I want to do traditional dollars and get a tax deduction. You will get a $31,000 tax deduction on your return. So let's say you were making 200 grand a year. You put in 31,000 to your 401k, you're 50 or older here. That means your taxable income would be $169,000. Now this helps me. I'm saving taxes now, and that's the benefit of traditional contributions. You're getting a tax deduction now. However, under the new rules, because you're making over 200 grand, and I'm gonna get to how you calculate this and the exact numbers here in a second, but I just wanna illustrate the big picture. In this scenario, you're making over 200 grand a year, you will not be able to make an additional contribution of $7,500 that is traditional. You can still put $7,500 in, but the IRS will force that to be a Roth contribution where you do not get a tax deduction. I love Roth dollars. I love Roth IRAs, Roth 401ks. Remember, that money is going to grow and come out totally tax-free. That's the benefit of Roth accounts. Your traditional account, traditional IRA, traditional 401k, where you get a deduction to put the money in, that's nice. I'm saving taxes now. As I'm building that account, I don't pay any tax. But when I start pulling that out at retirement, let's say I'm 65 or 70 and I start living off of this account, you can get it at age 59 and a half. Let's say you're pulling it out at 65. That goes into your taxable income. So if I take $50,000 in distributions from a traditional account later on in retirement, I'm taking that in income and I'm paying tax. But the Roth dollars coming out, no tax on the way out. Okay, that's the difference between Roth and traditional. The benefit of traditional, tax deduction. The benefit of Roth, tax-free on the way out. Now, this is the key thing here. In 2026, you will no longer be able to pick and choose and do a traditional contribution for the catch-up. Now, the dollar amount here is what they've considered high income. Now, this amount is $145,000, but this is not your adjusted gross income. This is not your married filing joint income for any of you who are married. This is simply your FICA wages from your W-2. For any of you self-employed people, this is your W-2 from your S-Corp. You got a day job in corporate America. This is your W-2 box 3 that is your FICA wages. So if you have other income or you have a spouse with income, maybe you're making 200 grand a year, but your W-2 is only 125 grand, this does not apply. So it's focused on the W-2, and there's a few ways we got to talk through this and some loopholes I want to talk about here in a second. All right, so in 2026, for your 401k, the catch-up contribution of $7,500, you must do Roth if you have a W-2 for the prior year. In this instance, let's talk about 2025, was your FICA wages on your W-2 $145,000 or more? If it was, that means you cannot do traditional catch-up contributions starting in 2026. And when you're in 2027, you're going to look at what was your 2026 W-2, okay? This is not your adjusted gross income. This is not your married filing joint income. This does not include your investment income. This does not include your 1099 and other self-employment income. This is specifically W-2 income on a W-2, your FICA wages. Now, I know this seems a little bit odd. You're high income and you're forced to do a Roth catch-up contribution. But in a Roth IRA, if you have high income, you can't even make a Roth contribution and you're forced to do traditional contributions. It makes no sense. I don't know, write your congressman. But the weird thing about this is in IRA land, when you make more than $150,000 a year as single, you can't make a regular Roth IRA contribution. You're too wealthy. You're forced to do traditional contributions, or the solution, do the backdoor Roth IRA, which we love for high income earners. But here in the 401k, they've done the exact opposite. They've said, if you're high income, making $145K or more, and you want to do a catch-up contribution, you must do Roth. Try to explain that to someone. How does that make any sense? I don't know. This is Congress, right? Your senator. But that is how the rule works. You've got to understand this. Don't think about the IRA rules. You'll get confused about this. This is a new rule for 2026 affecting your 401k and catch-up contributions. Hey, I'm cutting in here because I want to make sure you know all the stuff I'm talking about on my YouTube channel, investing in alternative assets, whether it's real estate or private funds or private equity, oil and gas, crypto, saving on taxes, all these concepts I love and I talk about here. I want to let you know we do this at my company, Directed IRA. So get on over to directedira.com/call and book an appointment with one of our self-directed IRA specialists that'll help you understand how to take control of your retirement. All right, now let's illustrate the difference between 2025 and 2026 and how this rule affects you. Let's say you're someone that's trying to get tax deductions on your contribution. You're doing traditional contributions into your 401k. You do the $23,500 as an employee contribution, you get the deduction. You do the $7,500 catch-up, you get the deduction. Remember, we're talking about 2025 here. So that's a $31,000 deduction. If I'm making $200K a year, now I'm getting $169,000 of taxable income, okay? It reduced my taxable income, which means I'm gonna pay less tax. Now let's fast forward to 2026. And let's say you wanna do a $23,500 contribution, traditional dollars. You're still chasing tax deductions. You want tax deductions. However, you do not have the choice to do a catch-up contribution that's traditional or Roth. This $7,500 additional amount is Roth only. So now that $31,000 deduction I got in 2025 will be slashed down to $23,500. Now, is that a bad thing? Yeah, you're gonna pay more tax in 26 than you did in 2025, but I actually think this is a good thing. Short-term pain for long-term gain. This $7,500 that's going in as Roth, you did not get a tax deduction for it, but that bucket of money is gonna grow and come out totally tax-free. Okay, that's the difference of the Roth. So it's forcing you to take a lesser deduction, which means you will pay more tax to the government. Now, why did this rule even come about? This was a rule change in 401ks and Secure 2.0 a few years ago. And the reason the government did this rule change was to raise money. Okay, those in their 50s are the people who contribute to their 401ks the most. They're the most likely group of people to max out their 401k, who take advantage of the catch-up contribution. And by restricting them from taking a deduction on the catch-up amount here, the $7,500, forcing it to go Roth, that means they're limiting deductions, which means you're paying more taxes to the IRS now, which means Congress gets to spend that money. What does Congress love doing? Spending your money, all right? So by doing Roth, that actually gives the government more money now, but you get the benefit of tax-free growth and tax-free wealth on the back end as you're starting to pull money out later on in retirement. So if you're someone that's been trying to max out your contributions, get as much saved for retirement as possible, and you're trying to maximize your tax deductions, this is going to affect you. But I think it sucks now because you will pay more in taxes, but I think you will thank yourself later in retirement as you're pulling that money out, these catch-up contributions and all of that growth is going to be coming out totally tax-free in retirement. All right, there's another important thing I want to make sure you are aware of here, and this is the super catch-up contribution, also part of Secure 2.0. This applies to people specifically ages 60 to 63. I don't know why Congress decided to throw it right here, but those of you who are age 60 to 63, your catch-up contribution increases from $7,500 to $11,250. Now, if you're in this bucket where you can do the super catch-up contribution to your 401k, that also must be Roth if you're over the $145,000 FICA W-2 wages, remember, on your individual basis. So this $11,250 will be Roth dollars. You can still choose on the $23,500 to do traditional or Roth, but the super catch-up also has to be Roth dollars as well. Now, this does not apply to simple IRAs, SEP IRAs. Okay, we're only talking about stuff that starts with a 4, 401k, 403b, 457. These are your typical employer-sponsored plans. This is where this catch-up rule applies to. The other important thing to note is you will be restricted from making a catch-up contribution if your 401k or employer plan does not allow for Roth contributions. Now, 99% of plans out there have now been amended or are being amended to include the Roth option. It's been something that's been around now for 10 or 20 years, but there are still some living in 1980 that haven't adopted the Roth option in their 401k. And if that's your plan, your employer's kind of screwed you if you make over $145k a year, because you will not even be able to make a catch-up contribution if you exceed the income limits. Now let's go over some unique situations, maybe some loopholes here, where you could still take this $7,500 catch-up contribution as traditional dollars and get a deduction. For example, let's say you're a self-employed person with a solo 401k, and I know what you're thinking. Matt, I made $300,000 in my business this year, but I took a $100,000 W-2 and $200,000 came through to me in a K-1 from the business. Can I take this catch-up contribution and take a deduction as traditional dollars? Yes, because your W-2 is only the thing we're looking at here, and that was $100K. The K-1 profit is not taken into consideration here. It is not factored in. So don't worry, those of you with a solo 401k or your W-2 is under 145K, this does not apply to you. Also, any of you that have had 2 jobs within the year or 2 jobs through the full year, doesn't matter, change jobs, whatever, it is only per employer. So if you have 2 W-2s on your tax return and combined they're only over 145, that does not count either. We only look at the 1 W-2 and the 401k plan associated with that W-2. So a little simpler here, a little easier to follow, and also compliance for the 401k administrators. Now, I want you to be thinking about your 401k plan here, and I love people who are trying to max out their contributions, do the additional catch-up contribution when they're 50 or older. For those of you 60 to 63, do the super catch-up contribution. And I'm a big fan of the Roth. If you're someone who likes maximizing retirement savings, I'm telling you, the Roth will benefit you in the long run. When you're in your 70s, you'd rather have $1 million Roth retirement account than $1 million traditional retirement account, because the value of that $1 million coming out in retirement is $1 million from a Roth account. The value of $1 million traditional 401k in retirement isn't $1 million. It's really about $700K, because I'm paying 25% federal income tax, 5% state income tax. That means $250K is going to the IRS and $50K is going to the state. I'm really only realizing $700,000 of that savings. So if you're trying to sock as much money away that you can live on and benefit in retirement, the Roth account wins out. Again, short-term pain, you are paying taxes, not getting a deduction for long-term gain. That's why I do not think this rule is actually a bad thing. I love getting tax deductions now, believe me, but in the long run, Roth accounts can win out for you because you have more dollars saved that have more meaning to you and more impact because you get to spend every dollar of that coming out of the Roth account. Now, I do love a good tax deduction. Don't get me wrong here. Don't misunderstand what I'm saying here, but there's a lot of ways we can get tax deductions on your tax return. I want to make sure you're only paying what you absolutely have to the IRS. So please subscribe to my channel. I've got a lot of tips on saving taxes, protecting your assets, and building wealth. I'm Matt Sorensen. We'll see you next time. All right, we all ready? Deduction limitations. Again, we're going to address when that occur, or if you have a self and get a deduction right now. Here's this. For example, let's say you're a self-employed person. Let's say I'm in a 25% federal state